If you don't buy a house in Canada this spring before interest rates drop, you're never going to be able to buy a house. And I'm going to tell you why that is the worst piece of advice you can possibly take. Hey there, and welcome back to Bald Prairie Real Estate. My name is Matthew Pfeifer, real estate agent in Regina. That's my trusted assistant, 𝗵𝗲𝗲𝗏. This is the weekly news recap where I go through the most interesting Canadian real estate related news topics, give you my thoughts and opinions on them. We're going on an Easter special here. Got a couple of hidden surprises in this week's episode. We're going to be talking about why that advice of jumping into the real estate market right now is absolutely terrible. The new changes that 𝗬𝗂𝗄 is making that could have an impact on the Canadian real estate market. The government of Canada has all of a sudden decided, hey, immigration levels are way too high, mainly because we're lagging in the polls, and we need to change that. That's going to have an impact on the real estate market. And they've announced the Renters' Bill of Rights. It's going to sound an awful lot like the Homebuyer Bill of Rights that we were talking about 2 years ago. And there's also a kind of a topic I think is really important to talk about, that is extended amortizations. A lot of interest around that and a lot of misinformation. So we'll be talking about that as well. But as always, let's start off with another one of my terrible bad dad jokes. What does a cow use to add and subtract? A calculator. If you have a terrible joke that I can use in a future episode, put it in the comments below. Let's get into this week's Canadian real estate news. The first article we're talking about is from the Financial Post, where an expert says if you do not jump into the real estate market now, you may get priced out. I hate news articles like this, and this goes to both sides of the equation here. Whether you've got somebody saying like, here, buy now or else you're going to get priced out of the market, or the people who are saying, wait, because the market's going to crash. And if you notice, for both sides, neither of them are going to pay you the difference if they're wrong. If prices don't continue to go up, they're not going to pay the difference for how much you paid versus how much you could have paid for it later on. And those that say the market's going to crash, if the market doesn't crash and prices continue to go up or even just stay the same, they're not paying you the difference either. So don't buy because someone is using fear. Again, fear of missing out in terms of prices continue to go up, or fear the prices are going to crash. Don't listen to those people. You buy a house when it makes sense for your own personal situation. There are a number of reasons why you may need to or want to buy a house, and you do it when it makes sense for your situation and yours alone. Real quick pause here. If you're thinking about buying a house in Regina, obviously I'd love to help you out, but if you're somewhere else in Canada, don't worry, I can get you set up with a perfect real estate agent that'll handpick for you. If you check out the description of this video, you're going to see a link to my calendar where you can book me in for an agent recommendation consultation. I'll give you a call, learn about what's important to you in a house, in a real estate agent, and I'll get you set up with that perfect agent in your market. And now let's get back to the video. Next up is an article that kind of dropped out of nowhere, and it's new rules from 𝗬𝗂𝗄, the Office of Superintendent of Financial Institutions. 𝗬𝗂𝗄 is the one that regulates banks and mortgage criteria, all the rules around getting a mortgage in Canada. 𝗬𝗂𝗄 is the one that sets those overarching rules. And this policy that they've put in is saying that the banks cannot lend more than 4.5 times for a mortgage amount versus someone's income. And this, I think a lot of people read the headlines really quickly and then started thinking that this was a more significant policy or different policy than it actually is. So we have to kind of unpack this here. First off, again, it is mortgage to income, not purchase price. So that means somebody could have a very large down payment, and that purchase price could be well in excess of 4.5 times their income, as long as the mortgage amount is not 4.5 times their income. But this is where the other part that a lot of people missed. It is not at the individual level, it's the mortgage portfolio as a whole for that lender. So they could have individuals that could be significantly higher than 4.5 times their income, while others are below, as long as the average works out to 4.5%. Right now in Canada, the average for most lenders is around 2.5%, so they're well below this right now. The other side of this is that this policy is more forward-thinking. It's a good idea going forward, but today it has basically no impact at all. It has no impact at all because the interest rates where they are today, early 2024, are high enough that they're already capping it well below that 4.5%. This only really comes into having an impact on the market once we see interest rates drop below the stress test threshold rate. So that's 5.25%. Again, remember, the stress test says you have to stress test at 2% higher than your quoted rate, or the stress test rate is 5.25%, whichever is higher. So until we see interest rates drop down to that, 3.5-ish%, this policy basically doesn't override what already is in place. So it's more kind of as a fine-tuned stress test. A lot of people said that this is actually what they should have done instead of the stress test, but we've got the stress test and now this. So right now, it's more of a forward-thinking policy, doesn't have impact today. It's not on an individual level, it's the bank portfolio as a whole. Next article here is the government of Canada saying they're going to reduce temporary immigration. When I did a short about this, I said it's really interesting when a government is way behind in the polls that all of a sudden the problem they created, huge immigration levels, creating problems in the housing market, becomes an important issue all of a sudden, even though a lot of people have been saying for a long time this was unsustainable. Yeah, I've been saying it for a long time too. So you've got a government now that is saying, well, we need to reduce the number of temporary residents in Canada. So they're gonna go from about 6.5% to 5% of the Canadian population. And that is a massive reduction. Again, I'm gonna say potentially here, because they're saying they're gonna do this in 2025, and it kind of appears to be they're framing this around an election promise. So we're gonna have to wait and see if they actually do this, and that is reducing the temporary immigration. A part of this is going to be from the reduction in student visas. That's about 1/3 of all the reduction they want to do. So we'll have to wait and see what they do with the rest, because if they actually want to see this reduction from 6.5% to 5%, there's two ways that you can go about this. And everybody's talking about how basically you're gonna shut the taps off and you're gonna have to tell people to leave Canada to hit the targets they're looking at hitting. Or the other side that I don't think many people are talking about. Again, this is not a total number. They're not saying we're gonna allow 200,000 temporary workers. They're saying they want it as a percentage of the population. So how else would you achieve this reduction in temporary workers? Increase the population. So if they change, for example, the permanent resident target and increase that significantly, of course, increase the overall population of Canada and would reduce the share that is temporary workers. So this is kind of up in the air right now, and at this point seems to me this is more of kind of test blimp type idea. See what happens, how does the public react to this? Because I have a feeling this is the type of policy that the government may want to run for an election on and use this as a plank for that election. Because right now they're not committing to anything. They're just saying basically we are going to do it in the future, 2025 at this point. Kind of wait and see if they actually do it or not. Let's talk about this Renters' Bill of Rights that the government is now promising is coming very soon. If this policy sounds awfully familiar, it's because we've kind of been here and done this before. In 2021, the federal Liberals said as part of their election platform, they were going to introduce a homebuyer Bill of Rights. They, of course, have also talked about a grocer Bill of Rights and a mortgage charter Bill of Rights. They kind of seem to like to use that term a lot. And the same arguments that applied when I talked about this in 2021 are going to apply to this policy today. And that I said at the time in 2021, the Homebuyer Bill of Rights was nothing more than political theater, political posturing, an election promise. This has a lot of the same feelings to it as well. Now, it seems that this government doesn't really care about this, the fact that they probably can't enact most or anything that they've promised in this Renter Bill of Rights, because rent, property rights, anything around real estate and property itself, that is all provincial jurisdiction and provincially regulated. And good luck getting all the provinces on board. They can't seem to get the provinces to agree on anything. And again, the government doesn't seem to care if they're trampling all over provincial jurisdiction and rights. They've tried this many times before, but I just don't see how they actually get this to succeed. For example, they want to have a national lease. Good luck. We have very different provincial regulations. None of this is going to work in terms of a national scale. And again, who cares about a national lease? Do you think anybody renting a property cares if they've got the same lease as somebody in Quebec or Ontario or BC, Saskatchewan? No, they don't care at all. And the other one where landlords have to disclose what they previously rented the property for. Again, do you think somebody cares that the property was up for rent 2 years ago at $1,500 a month, and now the landlord's asking $3,000 a month? This is supposedly going to give them more negotiation power. Well, if there's 10 people behind them wanting to rent the property, you got no negotiation power. We're at 1.5% vacancy rate. That's about as close to zero as you can get. It's the lowest it's ever been. Yeah, sorry to say it, but somebody that's renting a property right now, you don't have a lot of negotiation ability at all. When again, there's 10 more people, or in some cases, 100 behind you looking to rent the same property. The other two pieces of this regulation is that landlords are going to be required to report to the credit bureaus that the tenants are paying on time, and this is going to help improve their credit score. I can tell you right now that those that are paying the rent on time are also paying the rest of their bills on time for the most part. If you have a credit score that's good enough to buy a property, it's because you continue to pay your bills on time, and having rent as added to your credit score, you probably didn't need to begin with. But again, okay, I get where they're going with this. Good luck getting individual landlords to all be reporting each and every single month where their tenant has paid on time or not. Then of course, that also means this would work in reverse, that maybe potentially we have a way where landlords would know that tenants don't pay on time and then maybe choose not to rent to them. That can kind of go both ways here. And the last piece of this is that somehow the federal government is going to ban rent evictions. And I remember they said they were going to ban blind bidding. Yeah, it didn't happen. So again, this entire Renters Bill of Rights, I don't think it sees the light of day. I think they're going to talk about it a lot and then nothing's going to happen. They're going to use it to try to prop themselves up the polls and maybe try to fight an election on it. But I wouldn't be banking on this becoming policy, or at the very least, as it sits, maybe it gets watered down, but I just don't think this is going to become anything at all. Now let's talk about these extended amortization and what's going on with them. I want to do a quick refresher because I see it online that a lot of people are very confused about extended amortizations and how they work. I've seen people saying, well, everybody got extended amortizations. Not true at all. The only people that got extended amortizations, and I'll put this in quotations for a second here, is those that are on those fixed payment variable rate mortgages. Everybody else that's on a floating variable or a regular fixed payment, fixed interest rate, those didn't see any extended amortizations. And it's not a contractual extended amortization, it's called effective amortization, because nobody is now being given 40, 50 years to pay off their mortgage. You still have to go with what the original contractual obligations were. So for anybody who is on an insured mortgage, no more than 25 years. And if you're on an uninsured mortgage, no more than 30 years. The effective amortization is what happens when you see interest rates go up as much as they have, meaning that less and less of that person's fixed payment goes towards the actual mortgage principal paydown. The same thing also happens in reverse. If the Bank of Canada reduces interest rates, that effective amortization will shorten back down. But the key point here is that, again, nobody has these long-term amortization of actual contractual obligations. As soon as they go to renew their mortgage, they have to reset or snap back to whatever their contractual obligation timeline was. So nobody gets 50 years to pay off their mortgage. So what ends up happening is they either have to see those payments increase, or they're gonna have to make a large lump sum payment to catch back up. And this article has been specifically talking about what has been happening as these mortgages come up for renewal or lenders have forced people to catch back up. There was about $300 billion in extended amortizations at one point in Canada. That's been reduced to $220 billion. We're doing some real quick napkin math here, so don't take this as actual fact. Let's kind of do some rough numbers. That originally $300 billion was about 860,000 mortgages. It's been reduced now to about 630,000 mortgages. Remember, there's 5 million outstanding mortgages in Canada roughly, and about 1 million renew each and every single year. So kind of at this rate, we would see that all of these extended amortizations would be gone, and would be caught back up in about 2 to 3 years. Does this mean that everything's hunky-dory and everything's absolutely fine? No, it doesn't, but it is good news. We have not seen a significant rise in delinquency rates, and of course some people attribute that to these extended amortizations. That is part of it for sure, but we've also not seen this giant wave in new listings come up and hit the market because people are forced to sell because of these higher interest rates that they're now renewing into or having to catch back up and get back on the original amortization schedule.